It's interesting because Blue Owl got deeper into the real estate business by acquiring your business a number of years ago. So it begs the question on what the play is here.
It's a phenomenal entry point to real estate finance today. As traditional lenders are slowing down and you're seeing a pickup in rates and spreads, we think it's a great time to enter that marketplace.
When you say traditional lenders, are you referring to the slew of regional banks that are feeling pressured right now?
Correct.
How big is the opportunity?
Depending on how you look at it, $5 trillion plus from our perspective. And with the maturity wall at $1.2 trillion over the coming 12 months, again, just great time to enter.
How much of that is something you can actually tap into? There are so many concerns about the real estate environment, and I know when we talk to a lot of your rivals, they say you can't treat even property or commercial real estate all as one. You can't even treat office as a monolith. How do you think about that?
They're exactly right. And so commercial real estate is painted with an extremely wide brush. But to do commercial real estate finance, you can tap it a number of different ways. You can do your traditional mortgage, you can buy CMBS securities, or you can buy loans from banks that are looking to get them off their balance sheet. And all of those opportunities today present an excellent entry point.
It clearly shows that you have appetite for taking on some risk here. But what type of risk will you not be willing to take on? If you look at the market now, a lot of people are wondering what's going to dive deeper into distress.
So, look, if you look at our history, 15 years of doing single tenant, triple net, great credit, we've been extremely risk averse. And so when I think about the entry point into real estate finance today, I don't view it as a distressed opportunity play. I view it as a great value play. Because for the first time in a very long time, we're getting substantially higher risk-adjusted returns while taking less risk, i.e. sitting 50 to 60 cents in the capital stack and delivering 8% unlevered yields.
So you said single tenant. This is a good place to talk a little about the leaseback business that you do. How do you choose the right credits here, the right tenants, the right counterparties, when you're looking at who is in the buildings that you're actually in at a time where people can't even bring people back to work? Who do you choose?
Great point. So historically, the vast majority of our tenants have been investment grade companies. Okay, so when you think about our tenant base, it's Walgreens, Amazon, Whirlpool, Johnson Controls. And when you think about other real estate strategies, Sonali, we don't even spend time talking about the credit quality of their tenant base, right? But with single tenant, you do. And the way that we mitigate risk substantially is by focusing on great credit quality. But what's even more important is the triple net lease, okay? And there's not enough time spent talking about that. We've seen the data come out with obviously substantially higher rates, sticky inflation. The triple net lease is the perfect instrument to mitigate risk and give you predictable income while protecting your downside. And that's what we've been focused on.
You mentioned higher rates, so let's go there a little more. What does the impact of potentially higher for longer rates mean for your business and your industry?
Two things. So you got to think about it from the buy side and from the sell side. From a buy side standpoint, again, not to be cavalier, but that's a very good thing for us. Why? Right? So as rates creep up, you're going to see, especially with the combination of higher rates, less credit availability, and spreads increasing as well. Right? When you take that combination, it makes it harder for groups to transact, which makes it a better buying opportunity. And we're lucky enough today to be, to have just raised our 6th closed-end fund in excess of our hard cap, which puts us in a good position to be a buyer of assets. But again, something to mention on rates, it's not just rates. It's the combination of the three things I just mentioned. If you think about the rate environment over the last 2 decades, the highest interest rate environment that we've seen was actually 2006. 10-year Treasury, on average, 4.8%. So give or take 20 bips higher than where we sit today. But that was a frothy market. Why? Right? Because at that time, you had banks lending 85, 90 cents on the dollar, 10 years interest only, with 25 to 50 bip spreads. So rates are one piece of the puzzle, but they need to be taken in combination with credit spreads and credit availability.
So you just bought a new company or agreed to buy one. $10 billion in assets now on the table for you, plus you mentioned the fundraising that you've recently done. As you look to deploy fresh capital, what are the check amounts you're looking to write here? How much money are you willing to put to work at one time?
It's a good question. So it all depends on how much we like the opportunity. But we also want to be a holistic provider to the companies that we're dealing with. So if Company A wants to do a sale leaseback for $50 million, we want to be able to accommodate them. If they want to do a $2 billion transaction, we want to be able to accommodate them. And in this environment, being able to have that scale and speed to capital and deliver a proposition that reduces risk for the company is a tremendous arrow in our quiver.
Listen, Blue Owl has been kind of widely regarded here as one of the fastest growing firms on Wall Street. It's grown by acquisition. Do you see more acquisitions ahead for the real estate business in order to gain more scale?
I think we're doing fine for now, right? So never say never, but we're focusing on the acquisition that we currently have and deploying the capital base that we've just raised.